If there ever had to be a list of the elite value investors in the history of the world, then Seth Klarman would definitely have his place besides the geniuses like Warren Buffett and Howard Marks. Seth Klarman is a true disciple of the father of value investing, Benjamin Graham, who had written timeless books on investing, the security analysis, and the intelligent investor. Seth Klarman is an American billionaire investor and portfolio manager at his self-founded Baupost Group with his personal net worth of around $2 billion. In 1982, he started managing a closed-end fund of $27 million. And you would be surprised to know that those $27 million have grown on to become more than $30 billion today, with an average annual return of 20% for the last 40 years. That is one hell of a record. His book, written in 1991, Margin of Safety, is a value investing cult classic. With only 5,000 copies in circulation and publishing stopped, the book on Amazon itself is worth $2,000 or 1.5 lakh rupees. Though the PDF version of same is still in circulation on the internet. Let's see what we can learn from the experience of Seth Klarman and his teachings from his 1991 classic. This is The Better Investor, helping you achieve your financial goals and freedom through organizing your finance, stock market investing, and learning from billionaires. And these are top 5 lessons from the book: Margin of Safety, risk-averse value investing strategy for a thoughtful investor. Lesson number 1: Investments and speculations. Market participants can be divided into 2 categories: investor and speculator. Investor, the one who owns a piece of business and in turn eyes on his share of profit from the cash the business generates, which in turn is reflected in its stock price or the dividend it pays out from its pool of profit. Whereas speculator is the one who buy and sell stocks based on whether they believe those stocks will next rise or fall in price. Their judgment regarding future price movements is based not on fundamentals but on a prediction of the behavior of others, which they call as trading pattern. They buy stocks because they do well and sell when they don't. Speculators are obsessed by predicting the direction of the stock price. In reality, no one knows where the market is going in the short run. Trying to predict it is a waste of time, and putting your money with that belief is speculation. Just like market participants can be classified as investors and speculators, the things or assets people buy can also be divided into investments and speculation. Both investments and speculation can be bought and sold. Both meander in prices and thus can appear to show investment returns. But there is one critical difference. Investments throw off cash flow for the benefit of owners and speculations do not. The returns to the owners of speculation depend on its resale in the market. The greedy tendency to want to own anything that has recently been rising in price lures many people into purchasing speculations. If you buy a farm, then you make money by selling the crop from it. If you buy a house, you make money by renting it out. If you buy a cow, you make money by selling the milk it produces. And if you buy a business, then you make money by getting your share of the profit it produces from the operation. However, when you buy a Bitcoin, NFT, you only make money when someone pays you a higher price for it. Same for any collectible or an art. You may be surprised to know that people have speculated over even tulip flowers, bidding their price to the moon. And same with Bitcoin. Generally, the people who really benefit by buying into speculation are the early birds, who buys the thing when no one even knows about it. When it becomes popular, it only awaits like a bubble waiting for a needle to burst it. More on it you can learn from the book summary of The Short History of Financial Euphoria. Lesson number 2: Stock price versus business reality. Successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands. By having confidence in their own analysis and judgment, they respond to market forces not with blind emotion but with calculated reason. Successful investors, for example, demonstrate caution in frothy markets and steadfast conviction in panicky ones. Indeed, the very way an investor views the market and its price fluctuation is a key factor in his or her ultimate investment success or failure. Many a times when we buy a stock and the price falls, then we get concerned and start to panic, thinking that market knows more than me and perhaps I was wrong to buy it at that price. However, if a stock was truly a bargain, then this drop in price must be an opportunity because now it has become even better bargain. Thus, it is vital for investors to distinguish between the fluctuation in stock price and the underlying business reality. A fall in the stock price may not be the reflection of the value of the business. If you look at the high or low of a stock price in just a matter of 1 year, the gyration is huge. For example, take the stock of famous diagnostic company of India, Dr. Lal Path Labs. Its stock price has made a low of $30 and a high of $56 in 1 year. In reality, it hardly happens that the underlying value of the business would double or half in just a single year. The reality is somewhere in between. The gyration of stock price to the extremes is basically first because most of the intelligent people want to buy the stock at the fair value, and this estimation of fair value differs from people to people. For a stock to trade, there has to be a buyer and there has to be a seller. The seller is convinced that the stock is overvalued or fully valued and thus a contender to be sold, whereas the person buying from him is convinced that the stock is undervalued or the business is going to do much better than others are expecting and thus he buys the stock. Out of these two, one of them is right. This difference in opinion creates supply and demand and causes the stocks to fluctuate. Also, it may so happen that a very big mutual fund which held stock of a business found a better opportunity elsewhere or has been asked by its investors for redemption. So he decides to sell the stock altogether to redeem money or sell and buy the other one. This selling causes supply of the stock to increase and thus temporarily causes stock price to deteriorate. However, the fundamentals of the business are unchanged and intact. Thus, we must not make the price the master in dictating our decisions and try to learn about finding the fair value of the business as correctly as possible. You can learn more about this from the book summary of the Little Book of Valuation. Lesson number 3. Avoiding big drawdowns. If you get a chance to pick one of the two avenues, you start with $100 and you make your investment in hedge fund. One gives you a return as much as the following for 5 years: 90%, 60%, minus 80%, 50%, and minus 15%. And the other person gives you the return as follows: 9%, 16%, 8%, 2%, and 0%. Which fund do you think would have made more money for you at the end of 5 years? Okay, so here is the answer. The first fund would have turned your $100 into $77 at the end of 5 years. And the other fund would have turned your $100 into $140. Isn't it surprising? Warren Buffett's first rule is never lose money. And the second is don't forget rule number 1. And Seth Klarman is a very firm believer of his friend. Seth says that avoiding loss should be the primary goal of an investor, and the example that I gave you a little while back is clear example of that how important is it for an investor to avoid big drawdowns. It does not matter if you achieve those double-digit returns in the long run. If you did not lose money, you would do just fine. While no one wishes to incur losses, you couldn't prove it from examination of the behavior of most investors and speculators. The speculative urge that lies within most of us is so strong, the prospect of a free lunch can be compelling, especially when others have already seemingly partaken. It can be hard to concentrate on potential losses while others are greedily reaching out for gains, and you are on the phone getting offers of shares in the latest hot initial public offering. Yet the avoidance of loss is the surest way to ensure a profitable outcome. Paytm IPO is one another case in point. Paytm, a loss-making online payment portal, IPO was one of the most awaited IPOs since pandemic. When everyone was making super returns by investing in IPOs, same was expected by most of the people. Without knowledge of underlying value, people bought into it and the result is here. The stock is down more than 60% from its listing price. Such can be horrors of neglecting the risk involved with an investment done without the right principles. Lesson number 4: the challenge of finding attractive investments. While knowing how to value business is essential for investment success, the first and perhaps most important step in the investment process is knowing where to look for opportunities. In words of Charlie Munger, why should it be easy to become rich? Value investing encompasses a number of specialized investment niches that can be divided into three categories: securities, selling at a discount to breakup or liquidation value; rate of return situations; and asset conversion opportunities. The first category of stocks can be found out on running a screener online, which will filter such companies. The liquidation value of a company is a conservative assessment of its worth in which only tangible assets are included. You can say that if a company has to go for sale today, stopping its operation, then how much money will be left after deducting all the liabilities such as borrowing, debts, etc. If a stock is selling at a discount to the liquidation value, then it is considered an attractive investment. If you are keen to learn how to calculate the liquidation value, there are plenty of good YouTube videos teaching you how to do that, and many books too. Second category of stocks are the situation of mergers and demergers. Sometimes to unlock the value of an operation, a company would decide to demerge one of its operation as a separate business, and the shareholders of the existing business get shares in some ratio of this new business. However, not all the owners of the old business want to own the new business. If the new business is an average small company, then big mutual funds and investors will sell the stock, leading to overselling and thus depressed prices with respect to the fair value of business, thereby giving opportunity to value investors. These kind of opportunities are hunted down by reading regular news and going through filing of the companies or word of mouth from other investor friends. The last category comprises of the companies that have filed for bankruptcy. When the news of bankruptcy is out, panic selling of the stock takes place. However, big investors and restructuring companies often come to bail out and take over operations of the business. And more often than not, the business again gets back on track after a few years. If the restructuring of assets happen, then the reward in such kind of opportunities can be humongous. But investors should be clear that such kind of investments need skill to analyze the balance sheet, the assets of the company as reported, a gut whether or not any big company would be ready to take on the field operations. Sometimes takeover may not happen at all and shares also go down to zero or delist, which must also be borne in mind by investors. An example of third category is a company named Magma FinCorp, which filed for bankruptcy after NBFC crisis, coronavirus crisis in 2020. All this depressed the stock price, all the way from 130 rupees in June of 2019 to 13 rupees in May of 2020. However, a large business conglomerate, Poonawalla Group, came to the bailout of the company by paying its debt and finally turned it profitable by September of 2021. The stock price rose from 13 rupees to 300 rupees within a span of less than 1 year. Such are the rewards of value investing if done right. However, many undervalued stocks do not fall under these categories and have to be found out through old-fashioned hard work. Stock making new lows, stock selling below their book value, or hunting in overlooked or over-pessimist sector may occasionally bear some fruit. Lesson number 5. How much research is sufficient? Some investors insist on trying to obtain perfect knowledge about their impending investments, researching companies until they think they know everything there is to know about it. They study the industry and the competition, contact former employees, industry consultants, analysts, and become personally acquainted with top management. They analyze financial statements for the past decade and stock price trends for even longer. The diligence is admirable, but it has two shortcomings. First, no matter how much research is performed, some information always remains elusive. Investors have to learn to live with less than complete information. Second, even if an investor could know all the facts about an investment, he or she would not necessarily profit. This is not to say that fundamental analysis is not useful. It certainly is. But information generally follows the well-known 80-20 rule. The first 80% of the available information is gathered in the first 20% of the time. the value of in-depth fundamental analysis is subject to diminishing marginal returns. David Dreman, a famous old investor, author, and a journalist, recounts the story of an analyst so knowledgeable about Clorox, a company famous for making bathroom cleaning chemicals, that he could recite the bleach shares by brand in every small town in the Southwest America and tell you the production levels of Clorox line number 2, plant number 3, and so on and so forth. But somehow, when the company began to develop massive problems, he missed the signs. The stock fell from a high of 53 to 11. Most investors strive fruitlessly for certainty and precision, avoiding situations in which information is difficult to obtain. Yet, high uncertainty is frequently accompanied by low prices. By the time the uncertainty is resolved, prices are likely to have risen. Investors frequently benefit from making investment decisions with less than perfect knowledge and are well rewarded for bearing the risk of uncertainty. One such example is what almost all of us witnessed during coronavirus. In the March of 2020, the markets tanked, some of the stocks declining by more than 50 to 60%, thereby putting these stocks in sweet spot of margin of safety. Most of the investors were reluctant to buy at this time, owing to the uncertainty of the pandemic situation and incomplete information about the virus as to how bad it will be and how long will it last, and so on and so forth. Now that almost every one of us has a fair clarity as to how pandemic has affected various business and how it would affect them in future, all the bargains have gone. Instead, the stocks have rallied much above in price to what they were actually worth before the pandemic. Thus, market rewards the investor for bearing the risk of uncertainty. Let's have a quick recap. The financial markets offer many temptations to vulnerable investors. It is easy to do the wrong thing, to speculate rather than invest. Going with the herd and the latest fad is almost never a good thing in the stock market. Stock price do not always reflect the business reality. Stock price may fluctuate because of various reasons apart from business fundamentals. Thus, it is the job of a value investor to exploit such discrepancies of price and value and benefit from them. Greedy short-term oriented investors may lose sight of a sound mathematical reason for avoiding loss. However, the effects of compounding even moderate returns over many years are compelling, if not downright mind-boggling. Value investing encompasses a number of specialized investment niches that can be divided into three categories: securities selling at a discount to breakup or liquidation value, rate of return situation, and asset conversion opportunities. But more categories do not fall into these three categories, which makes of buying good companies cheap and not necessarily at a discount to liquidation value. Investors frequently benefit from making investment decisions with less than perfect knowledge and are well rewarded for bearing the risk of uncertainty. The time other investors spend delving into the last unanswered detail may cost them the chance to buy in at price so low that they offer a margin of safety despite the incomplete information. That's it, guys. If you liked the video, please like, share and subscribe. I will come again soon with a summary of another investment book. Until then, cheers guys.